So this is an additional session of Tax 7705, International Corporate Tax, on Subpart F. Tonight we'll be talking about Section 956, as shown here. 956 has as its purpose preventing U.S. shareholders from getting the use of money of their CFCs. It doesn't matter how the CFCs earned the money. The idea of 956 is to cause taxation when the shareholder gets to use the money, even if it's not distributed as a dividend. Now, before we proceed with 956, I'd like to take a brief detour to what we've had so far in Subpart F. We've got 3 videos out there, 2 of them regular videos, 1 a webinar on Subpart F. And last week we covered foreign-based company sales income and foreign-based company services income. The handouts are available for both of those topics. I'm not going to do a complete recap of what Subpart F does, except just a little to get you into the mood for 956. We're covering 956 tonight, and the notes for tonight are available on Web Campus. So let's talk briefly about 956. If you pay a dividend, if your foreign subsidiary pays a dividend, you as the shareholder pay tax on the dividend. But what if the foreign sub just loans you the money? Well, people thought of that a long time ago, and that's one of the areas that Subpart F closed up and limited how much you can use it. Section 956 says if a controlled foreign corporation, or CFC, has earnings and profits, either current or accumulated, and has basis in U.S. property under a very limited definition, then the shareholder must include in his, her, or its share of must include in his, her, or its income that shareholder's share of the lesser of the earnings and profits or the basis. And there are coordination rules to prevent double counting of these earnings when they're either later Subpart F income or 956 inclusions, or when they are remitted as dividends. So let's dive into 956 a little bit more. The 956 inclusion is not a dividend. It's an income inclusion, just like other Subpart F inclusions. It may look a lot like a dividend, but it's not. The sub keeps the E&P. The shareholder is taxed at ordinary income rates, not at preferential dividend or capital gain rates. 956 says we treat as income the lesser of the earnings or the investment in U.S. property. The amount of the investment is the CFC's basis in any U.S. property, computed on a quarterly basis. It's the average of the 4 quarter-end balances. This amount is computed in U.S. dollars, but everything, I apologize, this amount is computed in the CFC's functional currency. For the inclusion, it has to be translated to dollars. Now, if there have been prior inclusions under 956, then the total amount includable is reduced by the aggregate of those prior inclusions. This is fairly important to remember. It's not a one-on-one offset. It's compute balance A, compute balance B, and compute balance C, and then compare A and B, take the lesser of that number, and then reduce it by C. So A is the investment in U.S. property, B is the sub's earnings and profits, and C, the reduction amount, is the aggregate prior 956 inclusions. Not the aggregate subpart F income or subpart F inclusions, just the 956 inclusions. The result of this rule, using the aggregate prior inclusions, is that if you make a mistake, then that mistake follows you. If you take an aggressive position, the aggressive position follows you. Excuse me. Let me give you an example out of a case that resulted in this change in law. A guy named McCulloch had a CFC, and he included the wrong amount, too little, in subpart F income under 956. When he got examined, he argued that they ought to reduce the 956 amount by the correct amount of prior inclusions, even though the tax year was closed for those prior inclusions. Before the IRS lost in court, Congress changed the law. So that case, and the reason I haven't cited that case, is it's obsolete at this point. So the key thing here is average quarterly investment, limited to current or accumulated E&P, reduced by any current year distributions, and then reduced by prior inclusions. With any subpart F inclusion, including 956, the shareholder has the potential of getting a deemed paid foreign tax credit. Now, if the shareholder is an individual, this deemed paid credit doesn't happen. But if the shareholder is a 10% or more owner and a U.S. corporation, then we have the Section 902 credits. We'll talk about a limitation on those credits that was enacted a few years ago to prevent people like me from doing supercharged dividends or deemed dividends under 956. So backing up a step, investment in U.S. property is what we need to define. We know it's the basis, but what's U.S. property? Well, U.S. property is any tangible property. And before we go further, you'll notice when we're discussing what U.S. property is, it's a fairly limited definition. Tangible property in the U.S., stock of a U.S. related party, obligations of a related U.S. person, and rights to use intangible assets in the U.S. are all U.S. property. Now you say, okay, that seems to be fairly broad if we just go stock of a U.S. corporation. What if they invest in General Electric? Well, that's permitted. Excuse me. There are some exclusions from Section 956, and they're listed here. The key exclusions are cash, bank deposits, and unrelated party stock and debt. So these are things that, just because it's in the U.S. and you might think it's U.S. property doesn't mean it really is for 956 purposes. This stock or debt of unrelated corporations is really kind of the key focus of these exceptions. If it's a related corporation, then it's 956 property. It's investment in U.S. property. But if it's an unrelated corporation, then it's not. Now, this is stock or debt of unrelated corporations. Doesn't say anything about partnerships or individuals. So if the CFC loans money to an unrelated individual, there's a potential that you've got a 956 inclusion there. I certainly would advise against it. So let's focus a little bit on this related person debt. Related, if we loan money to a related U.S. person, say a consolidated return group member, then that loan to the related U.S. person by the CFC is an investment in U.S. property. What if we just have receivables from the related parties? Let's say the CFC in Germany, where the tax rate's high, manufactures some goods and sells it to a U.S. affiliate and doesn't collect cash instantly. You know, nobody collects cash instantly, except at the grocery store. So if we have receivables from related U.S. persons, those are also accepted from the definition of U.S. property, provided the receivables are ordinary and necessary, and they're outstanding only for normal trade terms. Now, these can be receivables for sale of goods or receivables for services. Doesn't matter. If it's just ordinary trade receivables, then it's excluded. Now, the IRS has, in a published ruling, said there's a 60-day default rule, if you will, for intercompany balances. This default rule is usually interpreted as first in, first out. So if my CFC sub sells me some goods on March 1st and the balance is outstanding April 15th, then that's okay, whether it's normal trade terms or not. I could be in an industry where the normal trade terms are 30 days, and here we've got a 45-day-old balance. Well, that's okay. We can rely on this IRS ruling. The ruling, however, is only for goods. It's not for services. My practical experience has been that IRS agents are keen to apply that 60-day rule unless it's some industry that has long-term receivables as the norm. So the IRS agents think 60 days applies to goods and services. That's a good thing. There are some industries where normal trade receivable terms are very long. In the garment industry, net 150 is what I've usually encountered. There are some other industries where long-term, less than a year, but longer-term trade receivables are very much the norm. So before you decide your receivables from the U.S. affiliate are outstanding too long, check what the industry terms are. If you're on the inside of a company, you'll probably have encountered this quite a bit just in other things not related to Section 956. If you're a CPA in public accounting advising clients, as a tax person, you may be clueless as to what the normal trade terms are. Go ask the audit partner or the audit senior manager on the job. They'll probably be able to tell you. Another key aspect is pledges and guarantees. If a subsidiary guarantees the debt of a related U.S. party, then that guarantee is considered an investment in U.S. property up to the amount of the loan guaranteed. If a U.S. shareholder or a U.S. consolidated return member that owns some of the shares, even if it's less than 10%, pledges those shares in support of borrowings of that U.S. person or of another U.S. person, then that's considered an investment in U.S. property if that U.S. shareholder pledged more than 2/3 of the stock. This is a really important aspect of Section 956, and I find clients getting tripped up on it all the time. They say, okay, my CFC doesn't have any U.S. property, so I'm going to go to the bank and the CFC is going to guarantee the loan. They're all going to guarantee the loan. Well, that's a real problem. I've seen inexperienced bankers insist that everybody in the whole ownership group has to sign on the dotted line guaranteeing everybody else's debt. And that's a real problem. That can cause massive U.S. tax that is not intended by the bank and hurts the bank. So if you encounter a bank saying, well, we've got to have those CFCs guarantee the U.S. debt, have the people at the bank talk to their tax people. They're not going to believe you. They're not going to believe me. Have them talk to their own tax people and make sure they get to an international tax person. If it's a small bank, you may run into problems. They may not know how to spell international tax. But if it's a larger bank, they'll eventually get to somebody that says, no, you can't do that. You can't have everybody pledging everybody's stock and everybody guaranteeing everybody's loans. It just doesn't work. Where we have a pledge or guarantee, it affects the amount of investment in U.S. stock. In U.S. property. And the amount of that investment is the amount of the debt guaranteed or for which the stock is pledged. Now, since the basics of 956 say the inclusion is the lesser of the amount of debt or the subs E&P, then that's what gets included under this pledge or guarantee provision. When you pay a debt, let's go back to pledges and guarantees. Over my 35 plus years of practice, this has been just such a recurring nightmare with novice bankers that I feel I really have to prepare you for it. And I lost my train of thought. Senility comes early sometimes. We'll move on and come back to it. When you pay a dividend, I remember my train of thought now. The dividend thing triggered it. One thing I've encountered with people that don't know what they're doing in writing loan documents is a foreign subsidiary pledging its own stock, or somebody that owns stock, somebody that doesn't own stock pledging the stock. So let's say we have 4 companies in the U.S. group, a U.S. parent and 3 subs, A, B, and C. Parent and A go out and borrow money. B owns shares of a CFC, and parent pledges the stock of the CFC. Well, other than that being just a total screw up, I don't have a problem with that, because the parent doesn't own the shares, so how can it pledge it? Now, I've talked to some very good lawyers on this issue before, and if the parent company pledges the shares of something it doesn't own, then you may have invalid debt that the bank can call anytime they want. So the consequences of the wrong party pledging the shares are perhaps even worse than the right party pledging the shares. So the key here is keep it under 2/3 and you're okay. Not 67%, that's more than 2/3. keep it to 65%. If you encounter a banker saying 67%, that's an inexperienced banker. So keep it under 2/3, and absolutely positively do not have a guarantee by the foreign subs unless you really want to trigger Subpart F inclusions today, tomorrow, next decade, anytime they have E&P, as long as that guarantee is outstanding. So just don't do either of these two things. Tell your clients not to do them. So when you pay a dividend from a foreign sub to the U.S., the earnings go from the foreign sub to the U.S. as dividend income, and the E&P of the foreign sub gets reduced. 956 doesn't work that way. 956 is sort of the monopoly thing. Do not pass go, do not collect $200. It used to be you could collect the $200, but you didn't pass go. When CFC has a 956 amount and the U.S. shareholder has to include it in income, then it skips over any intervening subsidiaries. It goes directly from, say, the third tier foreign subsidiary to the U.S. shareholder. The E&P stays in that third tier foreign subsidiary. The U.S. shareholder has an income inclusion. Hopscotch. Now, it used to be that we could bring a bunch of tax with it without having dilutions in between, but Congress wised up to guys like me and changed that law. So if we have a 956 inclusion, then the U.S. shareholder, if it's a corporation and meets the ownership tests, gets a 902 credit. However, that 902 credit is limited to the amount that the shareholder would have received if the 956 inclusion had been a dividend up the chain. Now let's do a new slide here and just do a quick example. Oops. Okay, you all got that, huh? And pardon me for not having this ready in advance, but it just occurred to me this would be the good thing to have. So if we have a 956 inclusion down here at the bottom, then that inclusion goes straight up to the U.S. Oops. Without skipping, without stopping in either of these two intervening subsidiaries. So 956 just skips over. But if we have a dividend, then it goes from the lower tier subsidiary to the next subsidiary to the next subsidiary, and then up to the U.S. So that's a really key difference in 956. Now, what if in one of these intervening subsidiaries we have a big deficit in earnings and profits? Well, 956 used to let me get these earnings out of the lower tier sub with their associated taxes and bypass this intervening deficit. That isn't allowed anymore. We have to limit the 902 credit based on whatever would happen if we moved earnings up the chain. And that can be kind of a bad thing. So that brings us almost to the end of tonight's webinar. There's one more thing I want to mention. There are rules under 956 that treat most varieties of factoring of U.S. receivables to be investments in U.S. property. Don't do the factoring of U.S. receivables. That's the bottom line. Just avoid that. So with that kind of ends our coverage of 956. Let's just do a quick recap. If CFC has earnings and profits, in fact, before I do the recap, I want to revisit this. This is something from Corporate Tax 1, your first corporate tax course. A distribution by a corporation is considered a dividend to the extent the corporation has current or accumulated earnings and profits. That means if it has current year E&P and has a big, huge deficit in prior years, then we still have a dividend with any distribution. 956 works the same way. It's current or accumulated E&P. So the threshold for triggering 956 is exactly the same E&P threshold as it is for dividends. So to recap, if we meet that E&P threshold and the sub has a basis in U.S. property as defined, then the shareholder has to include in its income the lesser of the basis in U.S. property or the E&P. We're going to cover the coordination rules of Section 959 when we get to that part of Subpart F. We'll see that 956 has its own coordination rule to prevent double inclusions, and then also falls under a separate part of the Section 959 coordination rule, coordinating Subpart F and dividends. So, at this point, I'm open to questions.